I'm looking at earnings right now. You're looking at earnings, 20% growth this year. I'm still looking at 8 and 9% for the next couple of years. Stock markets don't go down sustainably when earnings are headed north. Is it an issue? Yeah, liquidity is being sucked out of the market. But as long as inflation expectations can remain anchored at 2%, I'm not that concerned.
Well, that's it. Nobody's saying things are bad. In fact, it may just be the opposite. Bond yields, to your point, are moving up because things are good. I guess the risk is, are they too good? Are prices going to go up enough that Jerome Powell and the Fed are going to have to change those crazy dot plots, right, and get more aggressive on rates?
It's possible, but I think the bigger risk, Brian, is for asset allocators. Because you can't have all your money in stocks. You have to have an asset class that offsets equity risk. And in the past, that, of course, has been bonds. But it's hard to make an argument for bonds over the next couple of years. So what are investors going to do? They're going to have to turn to other asset classes. Could be long, short, could be tactical, trend, counter trend, even structured notes. But they're going to have to do something. Yeah. You can't jam it all into stocks.
Again, okay, so let's talk about that. Because, again, here's why bonds are important, folks. Again, not only are they a signal for many things, but they compete with stocks. So there's 74 million baby boomers. And they've made a lot of money in the stock market, and they look at the S&P with the dividend yield and whatever it is, and they say it was better to be in stocks than bonds. Now they're getting older, and they're looking at a yield on the 10-year of 3.21%, and I guarantee you, many of those folks are thinking, okay, you know what? I'll take a guaranteed 3% in the bond market at my age rather than risk it in equities, which means money could come out of stocks.
It definitely does suck money out, but they have other alternatives as well. They can go long equity, sell covered calls. There are a lot of funds out there yielding about 5%, doing just that, and they're getting growth to boot. So is it a risk? I don't see them going that high, especially given conditions around the world. The bigger problem and the likely problem lives overseas. If there's a black swan out there, it's somewhere in the emerging markets overseas, because rates going higher is bad for dollar-denominated debt.
How do you say black swan in Italian?
I don't know, but you bring up a great point, because when you see credit default swaps,
you saw what I did there, yes.
Yeah, when you see credit default swaps blow out in a sovereign debt like Italy, that's a concern. So that's why we're the magnet for capital right now. So it causes problem for them, but the biggest problem for me is that these are our customers, and if the emerging markets continue to do poorly, at some point it starts to hit the top and bottom line here.